Nizam Idris, head strategist fixed income and currencies at Macquarie, joins us this morning. Nizam, good morning. 2.81 on the 10-year. Some people are talking about it moving all the way above 3 and that having a corresponding commensurate impact on equities in the US and subsequently across the world. What's your view on the 10-year in the US?
Yeah, well, we have always been saying since we wrote our year-ahead note that yields will rise. And this is based on our view that U.S. growth is still accelerating. The late cycle fiscal stimulus through tax reform would mean both higher wages, higher inflation, and therefore I think this is quite a justifiable move. The question is whether it will break 3%. I think it will. What you want to watch out for would be first the FOMC statement on 15th of March. We believe they will hike. And then they will probably even hint more than the 3 hikes that is currently being priced. And then the next thing you want to watch out for would be the March inflation, which will be released in April, early April. And that March inflation will show a jump in inflation in the U.S. And that again would actually boost yields. I believe 3% will break. I think we could be headed for 3.2 to 3.6% by the middle of the year.
By the middle of the year itself, is it? And you're expecting 4 hikes this year or 3?
4 hikes. Our base case have been for 4 hikes this year. We believe that growth will also be stronger than market expects. Market is forecasting 2.7% right now. We have a forecast of closer to 2.9% growth. And that is contingent on the fiscal stimulus that was passed in December through the tax reform.
Yeah, fair enough. Nizam, I know that you probably necessarily don't have a direct view on this, but you do study the impact of rising yields on other markets from across the world, both currency and equity. Any thoughts on how you expect, will it be a straight line up for the dollar, given the weakening we've seen in the past and given the stated view of the US government on, a weaker dollar preference? And, what about equities and how that will respond to this? Because I don't think we can deny that all money flow to emerging markets will be linked to exactly how these 3 things move.
You're absolutely right. I think when yields rise in the U.S., then EM currencies tend to be the most sensitized to such move. Well, equities have to be repriced as well. So basically, it feels to me like currencies, bonds, and equities have been priced against a view of, lower for eternity. Lower rates for eternity. So this is really the case of secular stagnation being priced into equities and bonds. That's why you get yields. 10-year yields actually hit a record low of 1.3% in the U.S. last year, 2016. That can only be true if you expect secular stagnation. And therefore, that long extended period of low yields, low vols, suggests to me that people believe that lower for eternity is the right way to play it. So secular stagnation was in the price. Now you have to reprice that. You have to price out secular stagnation, and therefore everything have to be repriced. You have to discount equities of a higher yield, for example, and therefore we believe yields will go up. We believe equities will be under some pressure, multi-months, not multi-days or multi-weeks. And then we think dollar will strengthen, particularly against emerging market currencies, until such a point that you get stability in the dollar and yields. I think that stability should be around about 3.2%, not lower than 3%.
Yeah, well, Nizam, I think it's a good reminder this morning and this week and this month that easy money is not easy forever, right? I think
exactly. I mean, we have had almost 10 years of that. So, I think the market is just so used to this easy money. And the fact is that by the middle of this year, or in the second half of this year, global central banks will be siphoning money out of the system, not printing money. And this is the first time since 2009 that central banks are siphoning money out. So it's something new that you need to price in. I don't think it's fully priced in yet.
Yeah, well, it's not surprising at all, right? Because for all the people who all spent all of last year saying, hey, we've anticipated this move up in inflation and therefore this change in easy money policy, etc., and it's all priced into the markets. Well, good morning and see what's going on this week, right?
Yes, you're absolutely right. So even at the end of last year, people were talking about flatter yield curve, even potentially inverted yield curve. And, this is therefore likely to have taken a lot of people by surprise. And to that effect, I think, the knee-jerk is what you should expect first, which is what we have seen so far, 10% fall in S&P, for example. And then, past the knee-jerk, you still need to reprice asset prices based on that higher yields views. I don't think it's done yet. It's not a one-off phenomenon. I think this is a more structural change.
Nizam, you study the correlations. Give us an idea of how this will impact fund flows to emerging markets like India.
Yeah, well, higher yields, steeper yield curve, never been good for emerging markets. But you are right. You need to look at some more sensitized markets underperforming the others. And to that extent, in terms of correlation, then you would think the high beta currencies like Korean won, Indian rupee, Indonesian rupiah would do worse than, the lower beta like Sing dollar, Taiwan dollar, Thai baht. So, yeah, I mean, there need to be some distinction, but in general, though, regardless of whether you are high beta or low beta to such flows, I think Asian currencies will continue to weaken. Now, I think the trump card here would be China. If China slows down even further, then that could add to some organic negative for Asian currencies as well. So you got to watch out for that.
Nizam, what's also probably not helping matters is that the other central banks are sounding hawkish too. The Central Bank of England yesterday, the BOJ a couple of days ago, all signaled towards rate hikes and quicker rate hikes if it leads to that. The question is the start of the outflow that we've seen from the emerging markets as a result of those hawkish tones. Can it actually worsen and will it be a time protracted outflow, or do you think this will be narrow in nature? Because we've already seen about close to $1 billion being pulled out of India, and some of the other markets started that procedure since Jan 30th itself.
Yeah, I don't think it's a multi-day event. I think it could be at best multi-weeks, but potentially multi-months. So to your question, I think it could be a bit more protracted. Like I said, the last, since 2009, since the Lehman crisis, S&P has fallen more than 5% only twice. One was in 2011 when the US was downgraded by S&P. Right, the U.S. credit rating was downgraded. That is a one-off negative news. The next event that saw S&P falling more than 5% was in 2015 when China devalued its currency. That too was a one-off bad news. Right. This time around, though, it is driven by higher wages, potentially higher inflation. This is what everybody wants, right? I mean, all the policies are being designed to engineer inflation and growth. So why are we panicking? The only reason why we are panicking, the only tragedy here is that the market has been pricing in everything, discounting everything based on low yields forever. No, that has to change. And so it'll be a multi-month event, not a multi-day event.
Nizam, a quick question on volatility. I think we get the point, the macro point that you're making very clearly. But this fall also seems to be accompanied by a return to volatility. Of course, that was also expected to some extent. But there seem to be new volatility-led products out there that are complicating matters a little bit. Do you expect disproportionate volatility? Even if the fall is playing to a script in your head, which links into improved macros across the world and therefore higher rates, etc., etc.
Yeah, and I think that low vol is also part of the problem. As in, it creates complacency, firstly, and the second thing is that it also indicates, for example, low VIX at 10 for an extended period, almost throughout 2017, VIX index was at 10. So basically what it means is that, it creates complacency. Plus, it also means that a lot of investors are under-hedged. No one was really buying protection. And, what we are seeing right now is 33 in VIX. I think, the kind of normal level. So this normalization in some ways overshooting a little bit, but normal level should be around about 20 to 30. So I think we could get back to those sort of levels. Not necessarily a bad thing. Not necessarily a bad thing because, like I said, it is driven by positive fundamentals. Therefore, I think it requires that repricing before you can start buying again and things can go back to normal. Like I said, markets just misprice interest rate, misprice inflation, expect central banks easing to be ineffective, and well, now they're just rethinking that. I'm not sure exactly whether in 2 or 3 years' time, inflation will remain at 2% for everybody, and the world becomes a happier place. But for now, at least, you need to rethink this whole idea that secular stagnation is here to stay for eternity.
Yes,
okay.
and we're learning that lesson this week and learning it hard, as you can see.
Yeah, you bet. Nizam, just one last question. If you just look at the volatility, I'm sticking to that. The levels that we're seeing today are the ones that we last saw in August 2015. Any kind of correlations of such high spikes of volatility? Because I was looking at the 5-year graph of CBOE VIX. There have only been 2 instances in the last 5 years wherein CBOE VIX has been at such elevated levels.
2015 August, to be precise, 11th of August was when China devalued the currency, 1.5% higher in dollar CNY fixing that triggered a bit of a panic in the market. Even Brexit didn't see was this high.
Yes.
So I think it is an overshoot. VIX should, like I said, maybe 25 would be around about the normal level when the market is probably a bit more stable. But VIX at 10 is definitely wrong as well. So somewhere in between, I suppose, is the answer.